Dual aspect principle of accounting is perhaps the most important concept in the accounting process. According to this principle, any transaction impacts at least two accounts. Understand account as record for a particular item. Now, all these items in a transaction impact at least two accounts in the accounting equation, and here is the accounting equation for you. Assets equal to capital and liabilities. Given a transaction, we can identify two or more accounts which a transaction impacts, and no matter what the transaction, this equation always remains balanced. So now we will try and have a proof of dual aspect principle of accounting. The principle is based on a double entry system of recording transactions in the books of accounts, which means that all the transactions impact at least two or more accounts. Next up, what we are going to do is have a look at a list of transactions and get introduced to something called accounting equation and see how these transactions impact the accounting equation. This is a list of transactions that any business will have. We have 7 transactions here, and we are going to analyze these transactions and see what is the impact that these transactions have on the balance sheet of a firm. So I have a format here in which I'm going to illustrate to you the concept of accounting equation. Accounting equation is essentially the expression that shows the balance sheet to you. So assets are always equal to equity and liabilities. We have learned this when we looked at the balance sheet of Reliance Industries Limited. The two sides must always tally, and the same idea is expressed in the equation assets equal to equities and liabilities, and we call this accounting equation. Now, to have a proof of double entry system, we will look at each transaction one by one, analyze it, and see what is the impact that each transaction has on the balance sheet, and the outcome is going to be that both sides will always be equal. Transaction 1 is you start business with 100 million cash. So this means that business gets cash, but it also means business owes the amount of capital to the owner of the business. Whosoever supplies this money to the business has to pay it back to the business as well. Remember the entity concept principle of accounting. So after this transaction, you are going to have an asset called cash in the balance sheet, and also you are going to have a liability called capital, which is the amount brought in by the shareholders or the person who starts the business. So you have 100 in cash, but you owe 100 to the owner as well. So that is transaction 1 for you. Transaction 2, borrowed from bank 50 million. Now when you borrow in cash. So you have cash going up, or you could also argue that the amount is credited to the bank account, and you should have bank account going up, and in turn you will have a loan which the business will need to repay. So basically this means that your cash goes up. So after transaction 1, you have 100 in cash and 100 in capital. So the impact of transaction 2 would be the cash goes up as a result of the loan being taken, but also business now has another liability which is called loan, and this goes up by 50 at the same time, and this keeps, although increases the balance, but the total of both sides is still the same, hence proving that any transaction will function in such a way that balance sheet is always going to tally. The accounting equation always holds. So right now I have just treated cash and bank as the same, so I'm not distinguishing between two. One can do that as well. Transaction 3. Purchased office building worth 10 million. Now when you purchase building, you spend cash. So cash has to go down, negative, but you spent cash and in return you got building. So you have got something coming into the business, which means a building is the positive thing for you. And by spending cash, you have earned the right to claim the use of the building, which means building becomes an asset for the business. So cash goes down in transaction 3 by 10, but you get to have a claim on the use of the building, which is 10. And the result is you have same total for both sides in the accounting equation. Transaction 4. Purchased stock of goods worth 40 million on credit. You purchase stock of goods, which means that stock is coming into business. Business has right to use this or resell this stock, and in turn you have to pay cash for it. But guess what? You did not pay cash for it. You purchased this on credit. So if you did not pay cash for it right now, you will have to pay for it in future. And whenever you have to pay cash in future for the goods that you bought now, you have a liability to these people from whom you bought, and these people are called creditors, and the amount for creditors go up as well. So you have stock going up on the asset side, but you also have an item of liability going up, which is creditors, and the amount is 40 million. So you have in transaction 4 40 million worth of stock, but also creditors go up by 40. So the result is the transaction impacts both sides by equal amount, and the total stays the same. Transaction 5. Sold goods worth 20 million and 50% is on credit. When you sell goods, that means these are the goods that you had, and in transaction 4 you should notice that you purchased this stock of goods. So when you purchase the stock of goods, you had an increase in stock, so now you are going to have a reduction in stock. And when you sold these goods, you received some cash, so cash is going to go up. But guess what? You have 50% sales on credit, which means you did not recover 20 million cash, you recovered cash equal to 10 only, but stock worth 20 went out, which means that there is another 10 to be recovered from the customers. And the customers from whom you have to recover the amount, those are called debtors here. So stock goes out. So in transaction 5, you will have stock negative 10 and you will negative 20, correction, and you have cash positive 10, this increases, and you have another asset which is debtors, this is amount to be recovered, which is 10. So this results in the total still being same for both sides of accounting equation. Here, transaction 6, office expenses 5 million. Now office expenses 5 million means the cash went out certainly, so cash decreases by 5. Now what is the other item which is impacted? Now remember the income statement of Reliance Industries Limited. We match revenues to the expenses and then we find out whether it's a profit or loss. And whatever is the profit for the business, that goes to the balance sheet and is shown as reserves and surpluses under the equities head. Now if the profit goes down, the equities go down. Now in this case transaction 6 says office expenses. So whenever there is an expense, so any increase in expense will actually result in decrease in the profit. So any decrease in the profit would mean the capital of the shareholder goes down. All right. So the other item involved here is capital of the owner, which goes down by the same amount. So for transaction 6 we have a reduction of 5 in the cash and a reduction of 5 in the capital. So both sides are reduced by 5 and you still maintain the accounting equation here. Let's look at transaction 7 now. You pay bank loan installment of 10 million. So you paid, which means cash would have gone out certainly, and you paid back the loan, which means loan should also go down. So 10 million, we go to cash, which goes down by 10, and on liabilities side your loan goes down by 10. So you end up having the total of both sides of accounting equation equal, and this establishes the dual aspect principle in the sense that all the transactions will impact at least two items in such a way that the accounting equation is always equal. The balance sheet, the total of the balances of both sides of balance sheet is always going to be equal, and that's the dual aspect principle of financial accounting for you.